Great, welcome everybody. I think this is the second to last of our events this week on Kepler ratings. I'm really pleased to have Seb from Baillie Gifford, who manages Scottish American. All of us know it as Saints, so I think it's safe to say we'll refer to it as Saints throughout. Seb was just reminding me that Saints is 152 years old, so it's one of those investment trusts, and I don't think anyone's expecting Seb to project into the next 152 years of Saints, but he has prepared a presentation with a few thoughts about markets and Saints strategy, which will give you some idea of his thinking. And before I hand over to Seb, just to note that Saints results come out next week, and so there is a little bit of limited information on what the next dividend will look like. And as you'll see in the presentation, Saints also owns some physical property, unusually for what's fundamentally an equity income fund, and therefore there is a little bit of delayed information on the NAV that you wouldn't normally see. So the results will be worth reading next week for anyone attending, because there'll be a bit of an update on where things stand. And so just on a housekeeping front, those of you who've attended before will know all of this, but there's a Q&A box in the bottom right-hand corner where you can submit questions. I'll be able to see those questions. No one else will. So ask away, and I'll do my best to go through those with Seb at the end of his presentation, which should last about 20 minutes. And then this presentation and the slides to go with it will be available to look back on our website later on. If you're registered with us, you'll get a notification about that. And with that, I'll hand over to you.
Thank you very much, Alan, and welcome everyone for this to this presentation on Saints. So over the next sort of 20-25 minutes, I will go over, what is Saints, what is our approach, investment philosophy. I will show you the current portfolio, and then touch on performance. But thank you very much for your interest, and as Alan just mentioned, feel free to ask questions as I go along. But maybe first, starting with Saints at a glance. What is the investment trust? So the purpose, you can see in the top left, we have two really objectives for that investment trust. One is to sort of distribute a dependable income stream to our clients, and the second objective is to grow that income stream and capital in real terms over the long term, because we think that is what clients value in that investment trust. Now, the history is long, founded in 1873, and Baillie Gifford were appointed managers in 2004. The trust is managed by the Global Income Growth team at Baillie Gifford, and I'm the investment specialist for that team. Now, it is an income focused investment trust, and the dividends have been growing for the last 50 years until the end of 2023. As Alan said, results announced next week. I wouldn't expect a break in that long-term trend. Now, if you look at the structure of the trust of the company on the bottom right, you can see that the vast majority of the assets are invested in a global equity portfolio. We have a little bit of leverage on the company, about 10%. That debt, which is costing less than 3%, is invested in a property portfolio, which is managed by another manager, and a handful of fixed income instruments and listed infrastructure equities. So the vast majority of the returns over time will be driven by the equity portfolio, which is why in this presentation I will focus almost exclusively on that equity part of the investment trust. The bottom left chart shows you the income paid to shareholders since 2004, which has been well ahead of UK CPI. And again, it is quite important to some of our clients who rely on that income for their spending. So this is, the overall investment trust. Now, that dependable income, as I say, is very important for our clients. And we show here the dividends paid, since 1937. So the last time the dividend was cut was in 1938. And since then, it has grown or been sometimes stable, up until the end of 2023. And we show on this chart, a few of the major events that occurred over the period. And as you can see, a few crises, geopolitical crisis, financial crisis. The trust has been through a lot of different sort of periods and has managed to deliver that income growth through thick and thin, which we think is a very important feature. And it's also, to put into perspective, the trade war, potentially initiated by Donald Trump, is, not a big worry at the moment, compared to some of these big events we have seen in the past. Now, how do we manage, particularly the equity portfolio? And here we show the key features. And essentially, what we're trying to do is investing in compounding. We think compounding is the eighth wonder of the world, and we're trying to find, great compounding opportunities and hold them for the long term. So if you look at the key features, what we're trying to do is what you can see in the blue boxes there. We're trying to invest in growth companies which have sustainable business models, which pay resilient dividends, and we hold them for a long time to enjoy that compounding I'm talking about. So let me unpack those boxes briefly. So in terms of type of companies that we buy into, we want to buy these what we call relentless compounders. So these are companies which we expect to deliver around the 10% per annum, earnings per share growth and dividend per share growth. But for the next, 5 to 10 years, that is really the focus in terms of investment time horizon. So we try, from a universe of about 5,000 stocks, we try to handpick, 50 to 60 names that have these characteristics. We want them to have sustainable business models, and when I talk about sustainable business models, I talk not only about, the competitive mode, their positioning in their industry, their ability to, innovate, to maintain that sort of long-term growth prospect, but also ESG challenges, and how do they address these challenges that are, coming, in the next decade. For example, we want companies that are ready to address, their level of emissions, because over the next 10 years, there is a good, probability that, for example, the price of carbon starts to get to become a real cost for companies. So we want these companies that are getting ready for it. And we have developed this sort of proprietary framework, which we call impact, ambition, and trust, to assess our holdings, preparedness, if you like, in front of ESG challenges coming. We want them to pay resilient dividends. As I say, some clients really value that dependable income. This is something that is only tested, once in a while, maybe once every 10 years, you have a major crisis that really tests the income. So the proof point we show here is that, the pandemic was the last stress tests of that income, if you like. And in the pandemic, 9 out of the top 10 holdings in the portfolio maintained or raised their dividends. Bearing in mind that here global income was down about 15%, this is something that was very valued by our clients. And finally, we tend to hold companies for the long term. So the average holding period is about 8 years, which is very different from most market participants, where the average holding period is less than 2 years. And we think that has a number of sort of ramifications in terms of the approach to research, the approach to engagement with companies, which is very different from the average fund manager. These focus on sort of quality growth compounders is what allows us to serve two types of clients that you see here. As I say, some clients invest with us or invest in the trust for that dependable income which they want to grow in real terms. And some clients are more attracted by the sort of the quality growth of the portfolio and the fact that this allows long-term compounding, typically at a lower volatility than the benchmark, and that's what they value in the strategy. Now, I want to talk about the philosophy on this slide, and essentially, as I say, we think compounding is a great way to invest. But as income investors, we're also mindful of focusing on the right thing. And we think the right thing to focus on is dividend growth rather than the dividend yield. So in that respect, we don't have a minimum yield before we invest in a company. We really want to look at the next 10 years of income growth rather than the next 12-month snapshot of the yield that the market gives you. And this slide explains why. And we show here essentially two streams of dividends paid by two very different companies. So Microsoft is in dark blue, and RWE, which is a German utility company, is in light blue. And if you place yourself back in 2011, as an income investor, you had the choice between RWE, German utility, a good hunting ground typically for most income investors, paying a dividend of 7.4 euros, or a 7% yield. And compared to that, you had Microsoft paying less than a third of that yield in an industry prone to disruption. We did invest in Microsoft in 2010 because what we saw then was the possibility of earnings and dividend growth being quite steady and reliable and dependable over the following decade. And as you can see, this is what happened. What happened is RWE was overpaying, and the very attractive yield was something they could not sustain. And as you can see, because they had to pivot their business, reinvest more of their cash flows into pivoting that business, they had to cut the dividend and suspend it altogether in some years. If you compare that with Microsoft, which has started from a much lower yield but has been able to grow that dividend over the years, you can see in the table on the bottom left that the total income paid by Microsoft over that period was in the end more than twice the level of RWE, again, despite starting at less than a third. And we think that is illustrating our approach very well. That is why, to us, it's very important to focus on the dividend growth rather than the dividend yield. Obviously, the capital returns have been strikingly different between the two companies. And I will also point out that on that initial investment in Microsoft in 2011, the yield today is close to 9%. So again, that is the power of dividend growth, giving you better income over time. Now, dividend growth is great. We think dividend growth is also a great signal to help identify those long-term compounders that we're trying to invest in. And essentially, dividend growth is typically companies committing to a growing dividend, send a signal to shareholders that they feel confident enough in the strength of their business and have the long-term focus necessary to commit to that dividend growth over the next decade. And we think that's the characteristic of a great long-term compounder, which is why dividend growth is a strong signal. We also have evidence in history that dividend growth as a strategy helps and outperforms the market over the long term. So what we show here is the total return for the Dividend Aristocrats Index in the US, which is a subcomponent of the S&P 500, essentially companies in the S&P 500 which have raised their dividends consecutively for the last 25 years. So it's 69 companies at the moment. And as you can see, over the long term, they have outperformed the S&P 500. So there is evidence out there that this approach can deliver over the long term. Now, compounding is great. Finding those compounders through dividend growth as a signal is our approach. But what is also true is that finding those compounders is getting harder. And one of the reasons is the average lifespan of a company, which you can see here on the line chart, is getting lower. And so now it's about 19 years. And obviously, when the number of companies, sort of surviving and living long enough to allow that compounding to produce, its powerful effect, that pool of companies is reducing, due to notably, technology changes, disruptions, etc. It is getting harder and harder for companies to live a very long life. And we show here two icons on the right. General Electric for a long time was considered the ultimate compounder. Unfortunately, at some point became too focused on financial returns and essentially went bust and was broken up subsequently. You also have the example of WeWork, which at the time it listed was perceived as having mastered the industry of office working, management of offices, and history has shown that their lifespan was actually much shorter than a typical company. So it is getting harder to find these compounders. So how do we go about it? And we think the long-term focus is absolutely critical because the market is so focused on the next 2 to 3 years, and everybody, the sell side, the buy side analyst, the company's guide for the next year, everybody is very focused on that short term, which means that the market is relatively efficient on that short period. Where we think the market is less efficient is in that longer term period, the 5 to 10 years, because not many people are looking there. And that's what we're trying to put our focus on. So here we show, the difference with Mr. Market, illustrated by the hair, which is quite sensitive to short-term noise, as opposed to Saints, which is the tortoise in the fable and trying to grow, steadily over the long term. So Mr. Market, for example, is obsessed with PMIs, these monthly surveys of companies that give an indication of the optimism or pessimism in the industry. Now, this is a signal that changes every month. The market gets, quite excited about it every month, even though it has very little bearing on the long-term prospects of a particular company. We'd rather focus on some of the things that will have an impact on that long-term performance of the company. So, for example, we have an investigative researcher in the team, and she will go and speak to current employees, former employees, to try and build a picture of the more intangible aspects of a company, like a company's culture, for example. Something that is not critical for the next 2 to 3 years in terms of performance, but is critical to ensure the success of these long-term compounders. Another one is target prices. The market has, target prices, which essentially, helps, the brokers to generate trading, and trading is where they get the money from. So there is that obsession with target prices, where we think the underlying development of companies, the earnings growth, at the company's level is much more important than having to obsess about this target price. So every year, for example, we have a review of the annual results where we try and clean up the results, exclude things like exceptional, currency moves, M&A, to try and get a picture of the real underlying growth of earnings and dividends for these companies over the past 5 years, because that gives us a good indication of how these companies are developing, compared to our expectations. And finally, in terms of incentive, there is also quite a large difference. Mr. Market has typically a 1 to 3 year sort of incentive program, and we think that leads to a certain type of behavior that leads to hugging the benchmark to avoid taking a career risk, for example, by being very different from the benchmark. But ultimately, that makes it more difficult, we think, to outperform over the long term. Our managers, in terms of incentives, are incentivized on 5-year rolling total return and compound dividend growth. So again, a very different mindset, which is allowed by the fact that we are operating in a private partnership, which is very mindful of the long term. But that is a luxury for the managers, but it's a luxury that allows us to take that longer term view, which we think is critical. To give you an example, we show here Novo Nordisk, the Danish diabetes company, now the largest company in Europe. And we show examples of the type of research that we do into companies, which is different from most market participants. So we would do obviously the analysis of the financial statements, the analysis of the competitive modes, the competitive pressure in the industry, etc. We will do all that, normal work that sort of financial analysis entails. But we also try to go deeper to understand these longer term factors. So Hattie Oliver at 12 o'clock is our investigative researcher I was mentioning. And back in 2019, there was a change in management at Novo Nordisk. And Hattie went to do a report on the company to understand whether the new management was potentially going to be more interested in short-term financials and financial sort of results than keeping their focus on research and development, which is what has made Novo Nordisk so successful over the years. She came back with a report which was reassuringly telling that the management was indeed still very focused on R&D. And so again, that was one piece of the puzzle which we thought was very important for the long-term prospects of that company. Ross Matheson is one of the managers at 5 o'clock. He spoke to the leading scientists at the time of the trial and the sort of the surveys that were done on GLP-1, for obesity as an obesity treatment, at the time. So this was, back in 2019, well before Kim Kardashian and Elon Musk started talking about Wegovy on Twitter, and we think again something that back in 2019 wasn't going to change, it wasn't going to move the dial for Novo Nordisk over the following 2 years, but was potentially very significant over the longer term. So these are examples of the type of research that we do to try and understand really the long-term prospects of companies we own. The next slide shows you the portfolio, the equity portfolio of the company at the moment. We've classified, we show them to the x-axis is the forecast dividend yield. The size of the boxes is the size of the positions. And then we have a sort of classification of the type of growth that these companies are in. And this is a sort of subjective internal classification. As you can see, the bulk of the portfolio is in what we call compounding machines. So the light blue color. So these are companies which are very well established businesses with attractive growth prospects, strong management, very strong balance sheets, which are very important in a more challenging market and macro environments, and have delivered very steady earnings growth and dividend growth over the years. So you see companies like Coca-Cola, Procter & Gamble, Novo Nordisk in there. These will always be the vast majority of the portfolio. They provide the backbone, and they provide a very important resilience in the more challenging challenging times. The second largest grouping typically is what we call exceptional revenue opportunities. These are companies which are expected to grow faster. So the light blue would be expected to grow at around 10% per annum, year in, year out for a long time. The exceptional revenue opportunities, we expect them to grow faster over the next 2 to 5 years, at maybe 15% per annum. They need to reinvest more of their cash, so typically the dividend yield is lower, but we would expect over time them to become, compounding machines. So they will always be, a smaller part of the portfolio and providing a bit of a boost to the earnings growth. And then you have two much smaller categories, which we call management acceleration and long cycle returns. These are, more opportunistic ideas and provide some diversification benefits. So management accelerations are companies with, a great operating, asset base, but which were very successful in the past, have gone a bit sleepy, and maybe a new management comes in and is going to revive growth. So a company like Cisco System, for example. And then long cycle returns are companies which are on a different cycle than the typical macroeconomic cycle. And again, they provide some diversification benefits. So that picture of the portfolio that you see here is not changing much year after year. The average holding period is about 8 years. Turnover is low, is between 10 to 15%. Because again, we want our clients to benefit from that compounding that these companies can deliver. Now, stepping back from the individual names, we show here a few features of the portfolio and some metrics which again are not changing much over time. So the return on equity in the portfolio, typically at 23%, is much higher than the benchmark. Currently is about 15%. Now, this is for us a sign of quality. It's also what allows these companies to both pay a growing dividend and reinvest in their business, to grow, which again is very important because we want that dividend to grow over time. So, the high ROE and the quality is critical for these companies to be able to deliver both. The net debt to equity, so the leverage of these holdings, is typically much lower than the benchmark as well. Something that, as long as interest rates were near zero the last 15 years or so, didn't really matter much. But when these companies come up for refinancing now at much higher rate than they were expecting just a few years ago, we think again, comparatively, our holdings are in a better position. Now, in terms of price to earnings ratio, at the bottom there, you can see that we pay a small premium to the benchmark, and we think that premium is almost inevitable because to buy quality growth companies, you have to pay a premium. Now, our belief is that that premium can be maintained over time, and if the companies in the portfolio deliver that 10% EPS growth over time, with a valuation multiple that isn't changed, that gives you a very attractive return, above the market average of 7%. So we're happy to pay a small premium to the market to ensure the quality and the resilience of the portfolio. And I'll finish briefly on performance. So starting with the income performance on the left-hand side, as you can see, the income growth has been well ahead of UK CPI, again, something which is very important for our shareholders. The 2024 dividend will be announced next week, and I can safely say that the trend or the streak of 50 years of growing dividends is not about to be broken, but I can't say much more than that. And then if you look at the annual performance, annualized performance on the top right hand side, you can see that over the past 5 years, and I'm focusing here on the NAV because the share price will be dependent on the income, the sort of discount and premium. offered by the market on the shares. But for us, the underlying development is really the NAV which counts. And if you look at the last 5 years, it's about 10% per annum, with strong income growth and a very resilient dividend, particularly in 2020. Now, what is true is that last year was much more difficult in relative terms. In absolute terms, the NAV was up about 6.3%, which is very decent. But it's true that compared to the FTSE All World, we lagged quite a lot just on that 1 year, which obviously impacts 3 and 5 years numbers. So from a position at the end of 2023 when we had added 1 to 2% per annum over the years, we suddenly went behind benchmark, and I think the quality aspect of the portfolio is typically leading to a lower beta for the portfolio, so lower sensitivity to market moves, which is great in challenging environment because it provides more resilience than the market. But when the market goes up very strongly, and particularly last year driven by a handful of stocks, so 10 stocks explain 50% of the market return last year, we know that in that kind of environment we will give up some of the upside again to ensure the resilience and the quality of the portfolio is maintained. And this is essentially what happened last year, which has that impact. So because we believe that the AI rush that we saw last year, plus you also had a very strong rally from the more cyclical sectors in the market, particularly in the US, these are two strong headwinds to performance that affected the returns last year, which are unlikely to be repeated over the next 5 years. And so we think in terms of timing, having suffered quite a sharp sort of in relative terms, lag to the market, we think there is a good opportunity today. But I want to again finish on that dependable income, which is valued by so many of our shareholders, and we show here at the bottom left the UK CPI numbers since 1938, and then since 2003 when we took over the management of the trust. So the dividend per share for Saints have been on average 3% above inflation in the UK over those two periods, which again is something that our clients value enormously, because if you a young pensioner, you still have to rely on that income to grow, particularly now that maybe inflation is going forward is going to be more normal around the 2 to 3% per annum that we had seen for a very long period before the exceptional last 15 years. So that is a key part of the proposition, and that is what the managers are trying to achieve. So in conclusion, this is an investment trust invested in vast majority in growth companies paying resilient dividends, and we hold them for the long term for our shareholders to benefit from the compounding. I will stop here.
Thanks, Seb. That's really interesting. There's a few questions, and I'm going to start with. So I'm going to kind of try to meld a couple of questions here, but the theme of them, I think, is interest rate sensitivity and assets that you hold or you may choose to hold. It's been a big, obviously, operating in an income environment, you're going to encounter interest rate sensitivity. It may not be in every stock you own, but it kind of comes with the territory, doesn't it? Do you want to talk a little bit about assets that perhaps you've held that have disappointed, and how you go about assessing whether you should carry on with those things like bonds and infrastructure? And equally, we're kind of 3 years, I suppose, into higher interest rates, and perhaps we can start to make more informed decisions about what that means for some higher income opportunities now, whether they really are opportunities or whether they're still under pressure. So how do you look at those two things?
Yes, thank you. Definitely an important topic. So we have seen a step change in interest rates environment that has affected, particularly as you mentioned, those asset classes more exposed to sort of interest rates and more sensitive to interest rates. So the property portfolio, and we have a few more details in here on this slide. Sorry. This slide here. So it's about 9% of gross assets. As I say, managed by an external manager, specialized on property with an amazing track record over the long term. And as you can see here, the assets that we are talking about are, slightly different than your typical, office or, shopping mall and, residential property. These are typically, supermarkets. The biggest asset is a caravan park, and so very specific properties that the manager has handpicked and which pay on average about a 6% yield. So there is an attraction, from the higher yield, but also from the diversification benefits. Now, obviously, over the last 5 years, it has been a drag because interest rates have gone up a lot, and obviously properties are sensitive to interest rates. But again, if you assume that that environment, the step change in interest rates maybe has happened, and even though they won't fall back to the levels we were seeing 5 years ago, maybe the way going forward is not going to be as difficult, as much a headwind to properties. So in that respect, yes, we took some pain, but again, this is a particular environment. Going forward, the environment might change, and that is an environment where property might start adding value again, and definitely provide a higher yield to the portfolio. The other important thing with the property portfolio is the vast majority of those assets receive rents which is linked to CPI, RPI, or have automatic increase into them, and it's something that the manager has been very focused on, particularly over the last few years, because they could see the interest rates going up and they could see inflation picking up, and they wanted to make sure the assets were invested in or yielding real growth in income over time. So that helps in a way on the income side of things, in terms of rising interest rates. Infrastructure, as you mentioned, is a much smaller part of the portfolio. Indeed, has also suffered from these higher interest rates. But again, they provide a high yield, and some diversification benefits. So we put here some of the assets that are in there. Again, it's 3% of the gross asset, but you can see, we've got wind farms in the UK, you have medical facilities in the UK, you have electrical grid in the US. So very diversified, and help provide that benefit. Again, not in the last 5 years, but if we assume the next 5 are going to be different, again, that might provide a tailwind rather than a headwind over the last few years. On the equity portfolio, which is the vast majority of the assets, that is something which is, again, critical. And that's why, for us, focusing on dividend growth is very important, because in a way, dividend, and again, the temptation for an income investor is to look at the dividend yield and have a minimum dividend yield threshold, for example, compared to benchmark or whatever. We think that is very risky, because typically a company that pays a high dividend yield is a company that either has run out of growth opportunities. If you think of a tobacco company, for example, they can afford to pay all the cash they generate out in dividends, but it also means they don't reinvest in the business, and that means they won't grow, and that means the income they pay, which looks very high today, is not going to grow. It's almost like a fixed income, which again to us is not attractive, particularly if inflation is back to a sort of normal behavior. The other way for a company to show a very high dividend yield is to overpay. And it might be fine most years because nothing happens really. You know, the business goes along, everything is okay. But every once in a while, you have a more challenging macro environment for that company. And in that environment, they won't be able to sustain that dividend they were paying, and they have to cut. And there is nothing worse as a signal to investors than cutting the dividend. So that's why, you know, the temptation is to go to high dividend yield companies, but we think that is a dangerous game to play, and that's why the upfront yield we offer on the trust is, you know, not particularly high, and certainly within the sector will be at the lower end of the spectrum, you're at the bottom third of the spectrum. But because we think over time that dividend growth is much more important than the dividend yield. And as you can see, we have delivered income growth well ahead of inflation over time, which again is one of the critical objectives of the strategy.
Yeah, do you want to talk a little bit about, there's a question about value versus growth, and we've been through a period where looking at those two styles can show some very different phases, but I think perhaps quality growth has almost become a third category, hasn't it, in the way the market has bifurcated. So do you just want to talk a little bit about that? Because obviously, yeah, the sort of simple premise is, if you look at a growth index, the Mag 7's gone up a lot. You say you're a growth investor, so why are you behind them? You know, that's the kind of what's the thrust of the question. But I think there's a kind of distinction, isn't there, between growth and quality growth? Maybe you would just want to
Yes,
explore that a little bit.
thank you. Yes, no, absolutely. It is a very topical question. One thing to bear in mind when we look at growth value, you know, you have to bear in mind the way MSCI, you know, cuts the universe is very basic, and the way they do it is starting with value. They look at the, you know, bottom 50% of the market that is paying the highest earning yields. They have a few metrics they use, and that's how they cut the universe, and everything else is growth. So it's quite, you know, it's quite binary in their classification. Now, what is true is that Baillie Gifford is a growth investor, and we manage an equity income portfolio with a growth mindset. But within that growth spectrum, you have the super high growth, you know, and for us, you know, that would be like a Scottish mortgage, for example. It would be an example of being at a high end of the growth spectrum. This strategy, you know, Saints is much more the core end of that growth spectrum. And the quality feature is indeed, you know, the defining feature of this company, because the quality, as I was saying, is what allows these companies to pay a very dependable income, but also have enough cash generated to reinvest in their business to grow. Because again, we think growth is quite important. So you have very different levels of growth. We are aiming for that 10% per annum, but again, year in, year out, which means, you know, these very resilient businesses. If you think of a Procter and Gamble, a Nestle, you know, in a recession, you know, they do so much better than a lot of other companies. Now, the Max 7 is an interesting one, obviously has been a major driver of the market, you know, and if you look at our equity portfolio, in terms of the lag to benchmark, a third of that lag alone is explained by the relative underexposure to the Max 7. So we own Microsoft, we own Apple, but we don't own the other ones. And we don't have our head in the sand. You know, AI is clearly a game changer. AI is a technology that will have a profound impact on many industries and many businesses. But what we are, you know, maybe less good at is picking the winners that early in the race when everybody is throwing a lot of money at it, and it's difficult to find out who's going to benefit from that. So, for example, we own TSMC, the Taiwanese semiconductor manufacturer. They manufacture the NVIDIA chips. So again, we can clearly see that this is an important trend. What we don't want to do is, first of all, try and place some bets, in what remains a volatile sector, to try and pick the winners there. First of all, because the yield offered by these companies is pitiful. Second of all, because as I say, it's an industry very prone to disruption. So the next 10 years, typically sees quite a lot of changes in the leaders in the IT industry. And that's where, we rather focus on other types of companies where we have much better visibility in terms of the growth prospect. And they may not be as exciting, but we also know that they're going to be a lot more resilient. We also are convinced they're going to be there for the next 10 years and are going to beat their peers. So inevitably, there will be sort of in a portfolio, typically an underweight exposure to the large cap tech. As I said, for two reasons. One is the high valuation means the yield offered is very low. And second, it's quite a volatile industry. And then you have things like DeepSeek, coming along and showing you that this can be done at a fraction of the price. And all of a sudden, a lot of the investments probably have been wasted. And so this is not a call we think we can make. So we focus on that other part, the quality part of the market.
Yeah, thanks. And I think that leads neatly on to a kind of specific positioning in Saints, which is that you are quite notably overweight Europe versus US equities, and I think at a high level, lots of viewers will know European equities are cheap, US equities are expensive, but there's probably a bit more to it than that. So do you just want to expand on that?
Definitely something important. One thing I would say, firstly, is the exposure to the US economy is very different from what you see just by place of listing. So to give you an example, Nestle on the place of listing, when you look at the positioning in terms of region, Nestle would be a Swiss company, even though, less than 1% of their business is made in Switzerland. So when we look at the geographic revenue exposure of the holdings in the portfolio, it's about 42% in the US, when the benchmark is about 46%. So in terms of exposure to the US economy, it is not that different from the benchmark. And that's very important because obviously that is what matters for the underlying sort of earnings growth. The other thing is, because we are an income-focused strategy, we want to make sure diversification is very present, and diversification is key, particularly the currency diversification, for example. So the US is now 67% of global benchmarks. If you had 67% of your income coming from one currency, you are exposed to volatility in that currency, and then there will be some years when it benefits, and there will be some years where it will be a headwind. So we think it's prudent to be geographically diversified in terms of place of listing and in terms of income, sources of income, notably in terms of currency. The underweight US is a headwind, particularly when that US market is driven by those large cap names we talked about. So last year, the Max 7 explained 45% of global equity returns, which is incredible. And you alluded to valuation, and the US market is in the top decile of the 20-year period sort of range in terms of valuation. The gap with the rest of the world is again at a 20-year high. Now, there are some good reasons for it. Earnings growth in the US has definitely been stronger. The return on equities are stronger in the US market, but there is also a limit to that. So if you look, for example, at the discount of European equities to US equities, adjusting for the Max 7, i.e., you take out the Max 7 from the US, you adjust for the sector exposure, i.e., you make them equal weighted in both regions. Even looking at it that way, the discount in European equities is about 30%, and it's the highest it's been since 1995. So valuations don't matter typically over 3 to 6 months. Over longer periods, they matter, and we think again we are at the stage now where the U.S. trade is very consensual. Everybody is super negative on the rest of the world. Everybody is super positive on the US. We think it's more than reflected in the relative valuations of these two markets. And we think that's where there's an opportunity because, as I say, when you see products, which are 2 to 3 times leverage on NVIDIA share price moves, packaged as ETF, as we've seen in the US, that tells you that there's a little bit of exuberance maybe in some parts of the market.
Yeah, thanks. And I think a good place to wrap up is just given Saints's equity income objective is just to talk a little bit more about the dividends and the kind of dividend cover, board's attitude to using revenue reserves.
Yeah. So that is one of the benefits of the investment trust is the ability to build reserves. So at the end of 2023, again, I can't disclose numbers for 2024, but the end of 2023, the reserves were covering about a third, or there was enough to cover about a third of the dividend paid last year. Now, importantly, we really, really want the income paid to come out of the income generated in the portfolio. It's very important. So it's very rare that we use reserves, to pay that dividend. It's critical because, and there are some managers who choose to pay from capital, for their dividend, and we think that is all fine. The markets over the last equity markets over the last 5 years have been up, 12% per annum, which is exceptional. And I think that's what people forget. We had, 5 and 10 years of exceptional equity returns, which is a great environment to pay income from capital. But we also know that there will be cycles, there will be more challenging environments. And in those environments, when your capital goes down and then you have, reduced your capital over time because you have paid dividend out of capital, we know that's not sustainable. And so for us, it's very important that the income generated by the portfolio is what is used to pay the dividend. So there is definitely caution and prudence by the board when deciding on the dividend payment. And we'd rather, as I was saying, we'd rather pay a slightly lower yield, but ensure it's generated by the portfolio and ensure that it's going to grow over the next 5 years than paying a headline grabbing yield of 5% just to try and compete with a fixed income out there. We think that's a dangerous game to play.
Just out of interest, and don't worry if you don't know the answer, but I suppose this is the way to look at it, and it's how you looked at Microsoft. If you bought Saints 10 years ago at 100p, I don't know what the share price actually was. What would the yield on your book cost be, as opposed to the yield now? Because that's kind of the point, isn't it, of a trust like this, that it's compounding income.
So I don't have those numbers at the top of my head, but I would say over the last 10 years, I've got some numbers for the last 10 years in terms of compound annual returns for the dividend. So it's been about 3.3% over the last 10 years and 4.2% over the last 5. And in terms of the share price, sorry, the NAV total return has been 12% or 11.7% for 10 years. That's to the end of the last numbers to the end of 2023. NAV last year was up about 6.5%, so it's been slightly lower for the 10 years to the end of 2024, but not markedly different. So that is that is what we try to focus on. But I'm sorry, I don't have the yield on the original.
Yeah, if I was a bit quicker, I'd have got Chat GPT to do the maths for me while you were talking. But maybe next time. Maybe next time.
Yes.
Seb, thanks so much for your presentation and patiently answering all those questions. To our viewers, as ever, Saints has a very informative website where you can drill a bit more into some of the performance numbers that some people have been asking for. And Seb tells me there's still a few copies left of Saints at 150, and there's a link on the website. And I'm not on commission for saying that. And this presentation, as I said at the beginning, will be available for playback, and the slides will be available to download in due course. And with that, I thank everyone for their attendance, and thanks to Seb for his time today.
Thank you very much. Have a good day.